Hi, good afternoon, everyone. I hope you can hear me okay. I'm beaming into you from the Financial Times headquarters in London. I'm indeed a columnist here. I have a weekly column in which I write about everything from cryptocurrencies to AI to Donald Trump to culture wars. So I've got a very wide remit. And I'm very happy to be joined by some other panelists here. We currently have two panelists with me, and we're expecting a third who's going to join us, we hope, sometime soon, but he's running a little late. And that will be Pablo Hernández de Cos, and that is the governor of the Bank of Spain. And he's also a chairman of the Basel Committee on Supervision. But we do have here Jiun Chia, who is the managing director of the Monetary Authority of Singapore. And we also have Eddie Yu, who is the chief executive of the Hong Kong Monetary Authority. So welcome to both of you as well. And so today we're going to be discussing central banks and the rise of AI. Obviously, there's a huge amount of discussion about artificial intelligence these days, particularly with the release of GPT-4 last year. That created a huge amount of excitement and huge amount of fear about what AI could do. And with the launch of GPT-5, which is expected by the end of the summer, I think, I'm sure that we'll see a lot of newspaper headlines again and a lot of excitement and anxiety in equal measure, or perhaps more on the anxiety. Elon Musk has said that that artificial intelligence will overtake human intelligence by next year, whatever that means. In some ways it already has. And when it comes to people, we often, I guess we used to think that AI would replace blue collar workers, factory workers, and these days we seem to be much more concerned about white collar workers. Particularly people like me. It might be that I don't have a job in a few years. But when it comes to central bankers, it's not an area that we've kind of looked at, or that's been looked at a huge amount. A recent survey found that 56% of central banks, this is by FinTech Bookmarks, did the survey, 56% of central banks are using AI and or machine learning to some extent. A lot of them using it for projections and forecasting. Arguably, all of them are using it. We're all using AI in various ways every single day. Rudimentary versions of AI have been kind of used by central banks since kind of the 1980s. So the idea that 45% aren't using AI at all is a bit strange. I think they're probably all using it, but I guess 56% are kind of really actively using it. So what I thought I would start with is, given how much fear there is around, there've been various people, including Elon Musk, who've called for, a kind of 6-month halt on the development of AI, and there's a huge amount of fear that it's going to, basically wipe us all out. And there are some, obviously, there are levels of risks that AI presents, and that being the most extreme and perhaps, unlikely, we hope. But I wondered whether I could ask both of you whether there is, nevertheless, a kind of worst case scenario in terms of what AI, of the kind of not doomsday scenario, but something kind of bad that could happen that you are preparing for. Because obviously, financial supervisors are constantly thinking about systemic risks, which we're going to get into. But kind of, is there a kind of really big risk that you feel that, it might be a very unlikely risk, but that there has been some preparation for thinking about?
Well, maybe I can start first. Again, we're not talking about doomsday scenario where AI rule the world and destroy us and something like that. But there are risks that we are already starting to see, like concentration risk. It's likely that there will be dominant AI firms, dominant cloud computing firms that financial institutions are increasingly becoming reliant on. And if they are heavily reliant at some point in future on these dominant platforms, which might only be a few, if they fail, if there's an IT attack, if they have a failure, then there could be systemic risk or
Okay.
operational, at least systemic operational risk. That's one. I would like to just quote another one, which is something that I always fear, which is when malicious actors are using Gen AI for either fraud, scam, or false content, false rumors, especially when there's market stress. When people's confidence are low, all these false rumors in the social media that look real might actually aggravate the bad situation into a very systemic one.
Okay, thank you. Jiun, did you have anything to add there?
Sure. Maybe I'll take it from Eddie's second comment. To me, I think the main risk is AI in the wrong hands. And apart from scams and fraud, I would add cyber attacks as a key area of concern. We do know that these are daily occurrence, even at today's level of technology. We know with AI, it has the potential to turbocharge these capabilities for cyber attacks. And I think another dimension that is not perhaps talked about as much is that actually with AI, it has the potential to democratize, not in a good way, but democratize access to malware. So there is already AI capabilities that are available online for people who are not too sophisticated in their technical skills to access and to use it to develop malware. And they can use this, of course, to do their attacks. So I think it's a space we have to watch very closely. The banks and financial institutions are clearly aware. They're stepping up their game in terms of defenses against cyber attacks. And there is the potential to use AI as well in the defense. But it's going to be a bit of an arms race on both sides. But clearly, the right level of investments have to be placed in this and not to be taken lightly.
Okay, brilliant. Thank you. I think that's the first time that I've heard the word democratize used with, malware. So, okay, great. I think it sounds that your answer is basically, yes, there are some, and we'll get into these, and yes, there are some very serious risks, but it doesn't sound like that there are any kind of preparations being made for the kind of existential level of risk that some people are talking about. So, great. So I thought we could just perhaps start kind of going back a little bit, really, and talking about how it is that central banks are currently applying artificial intelligence and how they are planning to kind of harness that in line with the kind of advances that are coming very, very rapidly down the line. So Eddie, maybe I could start with you
Right.
to kind of give us a bit of an overview of what it is that how AI is kind of being used right now and how it's being seen in central banks.
Right. I think AI has been used by central banks for a while, as you said, in different forms. One common way of using AI is on oversight and monitoring capabilities, especially for banking supervisors. Because AI, they do have an ability to detect hidden patterns quite well, and also generate predictions using a huge number of data. So they're actually good in detecting anomalies, and also in fraud detection, in AML detection, in terms of anomalous payments. We're actually also using them to identify mule accounts. So that we can stop those accounts as fast as we can. And
Which account?
reassess the
Sorry,
mule
I didn't.
accounts.
Mule
Mule
account.
accounts.
Sorry.
Yeah, the mule accounts are the accounts that people use to launder their proceeds from fraud, from scams, something like that. And the other is, of course, risk assessment. Of course, we've always got the structured data through our returns coming from the banks, but now we can do the risk assessment using unstructured data by getting into social media threads, news report, etc. And in this, we're also piloting with a machine learning model that actually helps us assess the credit risk or credit loss faced by banks, so that we can take a more forward-looking view on their loan quality, taking account of the macroeconomic data. But this is on trial. As for Gen AI, we're actually just proceeding very cautiously. Of course, we'll use Gen AI like others do in terms of having a digital assistant, more like a summer intern that help you draft speeches, emails, collect data, find information, etc. But we are quite cautious about the use of it. We are also building an internal Gen AI model, but we're actually a little torn between how to have the right computing power and data while keeping confidentiality and security. We're starting with using our own private cloud and using an open source model so that we can adapt to using our own data. But there are constraints in that. But if we use public cloud and public data, we're a little worried. So we're trying on different things on Gen AI, but I think it's still early days for us, just like many other financial institutions.
Okay, interesting. And not just financial institutions. I think we're all kind of playing around with it cautiously. Yeah, I'm not getting it to write my columns just yet. So Jiun, could you talk about the specific areas that you feel that AI can bring the most benefit when it comes to central banks and supervision of financial institutions?
I promise I didn't coordinate beforehand with Eddie, but I find myself having quite similar points that he has made. So I think maybe just starting with AI as an internal productivity tool. I think central banks and supervisors are data-driven organizations. So the scale and scope for applying AI, machine learning, or even Gen AI is quite good. I think so. Speaking on Gen AI, certainly as a tool to retrieve, collect, process, summarize data, and then present that data back in a usable form to users. I think that is a very important generic use case for all knowledge organizations. So certainly, I think in our organizations, we're looking very seriously at using that as a productivity tool across all lines of our work. Now, one particular challenge, I think Eddie alluded to it, one particular challenge is how we balance these use cases with data confidentiality and privacy. We collect a lot of data, of course, from the financial industry. And we have obligations on confidentiality on data that we collect. So typically in our organizations, we have quite strict rules on data access. So I think as we think through about training models, making that data available for training models and making it available for search and also for summarization and processing and use, we'll have to think about how to overcome some of these traditional rules that we've had with regards to access of data and the protection of data. But I think we won't compromise that confidentiality, but we'll have to find ways technologically to be able to use that data, to be able to use that to train the model, and then to of course make it available for us to use and be more productive. So that's on an internal productivity basis. In terms of external, Eddie is absolutely right. Say in the central banking area, I think it's quite useful in terms of being able to trawl through social media platforms and the media to do various things. So certainly one aspect of that is sentiment analysis. So for central banks, clearly sentiments towards inflation is important to us, whether inflation expectations are well anchored. And so it's a tool that allows us to quickly get a sense of sentiments towards inflation and how that trends over time. For supervisors, there are many use cases, as Eddie has said. I think it allows us to access network data to get a sense of whether and pick out anomalies that may point to fraud, money laundering, potentially market manipulation and securities market regulation. So I think that there are many use cases in those areas. We've tried models in the areas I've just mentioned. They don't completely substitute for expert investigation work. So we see this as a complement to what the capabilities and expertise that's been already built up in existing channels. So we see this as a complement, and the leads that these models throw up, they prompt us to investigate and look further. There is an issue, of course, between false positives, and so they do need to be looked through carefully by experts. So
Okay.
I think at this stage, I would say that there's a huge reliance on them, but they've been a very useful complementary tool.
Mm-hmm. Okay, so one thing that neither of you actually mentioned, and given that you're both agreeing, and we want to people like to see panels where people aren't all agreeing, so I'm going to make sure that I'm keeping you. I'm going to be the person who asks questions to keep everyone awake this afternoon. So I'm going to ask another slightly provocative question, which is, so the part that you're not really discussing is I guess the rate setting part of central banks, the rate setting kind of section of a central bank committees. Clearly, you're discussing things, Jiun, like sentiment analysis, for example, of social media and other media. So what you're doing there is you're getting the AI to kind of scrape the Twitter and TikTok or whatever, and working out, well, what's sentiment on this particular thing, what's consumer sentiment, how are people feeling about the economy. But an AI can take that as well. So you're taking the AI to give you the analysis, but an AI can feed the analysis to itself or to another AI or whatever. And it seems to me that rate setting is just the kind of thing that an AI could do, actually, and that it could do potentially with less kind of and this might be a good or a bad thing, but without the kind of human emotions that might come in terms of, oh well, I don't really know the psychology of central bankers, but you do better than me. But if you've been hawkish, you want to continue to be hawkish because that's kind of part of your identity as a central banker. And whereas an AI hasn't got any kind of complications, there are no biases, there are no need to kind of continue down the same road. You can just take all the information that's there and make a kind of objective, unbiased, spit out a rate. And it might be the case that this ends up being more. Some countries find that using an AI to set the rates actually is better for the economy, better for inflation, better for the exchange rate, whatever. Is there a scenario in which at least that rate setting part of a central bank is actually replaced by AI at some stage?
That's a very interesting scenario. Maybe it'll happen one day when you can blame the AI for mistakes in monetary policy. But if a human has to take the blame, then the human will have to make the judgment. But maybe on a slightly more serious note, I think the last few years, central banks have come under some criticism of getting their forecasts not entirely right. So I'm not sure if the state of the technology is such that we can do this mechanistically. There is a great deal of judgment involved in understanding and having a view as to the forward path of inflation. There is a great deal of judgment involved in also having that view of the forward path of transmission of monetary policy. So I think we're not at a stage where it is entirely mechanistic. The models at this stage of development, of course, give us a very, very important parameter and input into our work, but they're not at a stage where they can supplant human judgment.
Okay. We'll see, I guess. We'll see if there are any countries that do decide to kind of trial this, and I guess there would be a way in which you could, an independent. Well, I guess you can't really monetary policy has to be implemented for you to see whether it was kind of right or wrong, I guess. So it would be difficult to kind of do a rival without actually being in charge of the monetary policy. Okay, thank you. I'll move on to another question. Another one for you, actually, Jiun. So obviously financial institutions are deploying AI in various ways. We've discussed some of them. There's, robo advice as well, chatbots, machine learning. How can they deploy these tools in a responsible manner? And what should the role of supervisors, financial supervisors, be in that?
Okay, so it's a big question.
Yeah.
I may take a little bit of time with this, if you allow. So maybe just take a little step back. So I think it's absolutely important that financial institutions are able to implement, deploy AI in a responsible, sustainable way. Supervisors and regulators have strong interest that they are able to do so without great mishap along the way. Reputations matter greatly to financial institutions beyond the financial impact of their decisions. So, it's all wrapped up into credibility and confidence, right? So I think there is the issue that they are able to do this well-governed and in a sustainable way. I'll just say that, there's a long history of regulators and the financial institutions working together to ensure that the models they use and the data governance and policies that they have in place are sound, right? So data and models have been used for the longest time in financial institutions, right? They've been used to inform credit decisions. They've been used to model market risk. They determine trading, hedging strategies, liquidity needs. Of course, used in insurance a lot. And supervisors have engaged with financial institutions through all these years in terms of ensuring that their risk outputs and their model outputs are good enough to drive decisions. And this used to be fairly straightforward to do. The models used to be predictive regression based. They were reviewed, updated infrequently, limited number of parameters in the hundreds. Model performance was straightforward to measure. Right. And explainability, accountability, all the buzzwords now talking about AI, these were relatively easier to do back in the day. Things started to change about 10 years or so back. Machine learning became much more extensively used in the financial industry. And so they were used also to assess credit quality, price loans, detect suspicious transactions, put into AML processes. And then, of course, also in the marketing area, predicting customers' interest in products and so on. And then larger data sets started to be used in these models. And so explainability became more challenging with a growing number of parameters. Data governance became much more important. So that was the start. So about 10 years or so back. Now, I'm taking you through this history because just to show that, it's not that AI is a sudden onset of interest in this area. It's been a bit of an evolution of development of capabilities in this area. And so both the financial institutions and supervisors have had to step it up over the years. So I'll just take you back to 2018, and that was when the MAS had issued guidelines on the adoption of AI, but this was in the age of traditional machine learning, right? So this was back in 2018. But then we were already emphasizing principles then that were important then, but still are important now, even with Gen AI. First, fairness in the selection of data, fairness in the outcomes of models. Clearest example of this is that credit rejections cannot be discriminatory. We emphasize ethical decisions and outcomes. So whether or not they're model determined, they need to be consistent with values and ethical standards of the organization. For example, policies on diversity, long-term orientation of banks towards supporting customers through the ups and downs of a business cycle, maybe support of low-income communities. In some cases of some other countries where they have rural communities, maybe that, or small enterprises. Then, of course, accountability and governance. Models cannot be let out into the wild. They have to be kept on a tight governance leash So supervisors would insist on this. They need to be constantly updated, check that they're performing appropriately and accurately and producing explainable outputs. And transparency is a point that is sometimes overlooked. So as AI becomes more pervasively used in decisions, there will have, I mean, I think if it does benefit from more disclosures to customers that AI and models are being used to make decisions that affect customers. So one example, of course, is in credit scores. All of us know that how data is being used, and as this output called data score impacts our ability to access credit. So, when financial institutions deploy more models and AI, I think this is an area that they do need to give very careful consideration to, how to engage with their customers to maintain trust and confidence by being very transparent about their use. Now, with Gen AI, with large language models, what I've mentioned, I think, is still relevant, and there's been an evolution, but there are certain risks now that are accentuated, and there's some new risks that we'll have to pay special attention to. Previously, data used to train models were generally collected by the financial institutions themselves. This was internal model, carefully selected, organized, tagged, and subject to very strict data governance. With large language models, these are very large, unstructured public data sets that are being used to train the models. And data governance will be much more challenging in this situation. Second area of change is that Gen AI now involves incredibly complex algorithms. They fit non-linear relationships involving billions, and I think with the latest iterations of the GPTs, maybe even a trillion parameters. So you can imagine that validating, benchmarking for accuracy, fairness, explainability becomes much more challenging. And there is also the added complication of dependence on third-party foundational models with relatively low levels of transparency. So this also adds to risk around legal liability. And third is now a need to address other areas of potential harm. We talked about cyber risks earlier on. Eddie mentioned data privacy, and there's also consumer harm. So if these are used to interact with customers, you need guardrails and filters against hallucination and toxic content. So I would say that at this point, the banks have been cautious about deploying Gen AI autonomously or into key critical areas. In our interactions, we understand that they've been using it a lot in internal productivity uses, similar to how we ourselves as organizations have been using it for internal productivity. They've also been using it as co-pilots in terms of coming up with advice and services to customers. So generally kept on a leash, generally co-pilot, human in the loop, not autonomous use. And it seems generally not used autonomously in major credit decisions or market risk-taking decisions yet. But clearly the potential is there. I think they're working and deepening the capabilities. So it's a matter of time before the adoption becomes quite pervasive in many areas of activity in financial institutions. So maybe I'll stop there for a little bit and see if you've got
Thank you.
Questions.
I have just one follow-up just on a definition. You said an intriguing thing, which was hallucination and toxic risks. What did you mean by hallucination in that context?
Well, so if Gen AI is used to interact with customers, say in giving financial advice or product advice, and we know from all our use of ChatGPT, and we know that this is quite well known that firstly there's a consistency issue. The chat does not come back with the same answer every single time you ask the same question. There is the issue that some of the content is not factually grounded, and so that's hallucination. And then, of course, third, there's the prospect that some of that reply back is not, how would you put it, polite. And may violate or may be offensive to if you hold certain values, it may be offensive. So there needs to be some guard railing that it speaks with a certain tone of voice, speaks with a certain vocabulary, and speaks with certain values that guardrail it.
Okay, so hallucination wasn't you were using it in the kind of context of fake news, I guess. But I do think you bring up an interesting point there, this guardrails and values, because clearly we don't all share the same values across this, between different societies and within those societies themselves. So I just wondered, you mentioned kind of ethics and talking about diversity and inclusion and that kind of thing, and baking that into the AI. And obviously these are issues that are very contentious and that people really, really disagree on how best to manage. And that's just when it's human beings. So how do you think about, and either of you could answer this, but just because you brought that up, Jiun, maybe you'd like to, how do you think about that kind of ethical part of this? And do you work with, I know, for example, a philosopher of Oxford University who's working with the Prime Minister of Greece on applying Aristotelian ethics to AI, believe it or not. So I wondered whether you worked with any kind of people who are specialized on ethics, and how you can think about how you even begin to start thinking about those kind of questions.
Yeah, so I think diversity is the harder one here, but I gave a few other examples where I think financial institutions will be able to adopt that quite readily. As I mentioned, there is, I think for some banks, they pride themselves in a value system that they will stick by their customers through ups and downs of a business cycle. Unless the sector or the company is fundamentally impaired, they will try to look through the cycle, and that's how they market themselves to customers. And so, if that is the value you espouse, and that is how you've branded yourself and how you have held yourself out to your customers, what we're saying is that supervisors, there is a reputational angle to this. And if you are starting to use models in making decisions, then how would these models be able to be giving you outputs that you use and decisions that you may use that are consistent with those values? So you have to check it for those values. Now, if the model is mechanical and is not able to embed or internalize these values, then you can't leave it autonomous. You have to have a human in the loop who will, of course, then apply that layer of values on it. So the same goes for diversity, right? Okay. So if the model is not able to, or you're not able to articulate clearly the diversity parameters for your organization that you want your model decisions to embed, then that may require quite a large element of human judgment. And then so in terms of your overall system, again, the model is a co-pilot, but ultimately judgment and decision-making may have to be in the hands of humans who will apply that value overlay.
Yes, okay, thank you for clarifying that. Eddie, maybe I could come to you. What do you think the role of central banks should be when it comes to supervising the application of AI by financial institutions? And do you believe that if AI kind of grows to the extent that we're, I think, all expecting it to, do you see the role of the central bank becoming bigger, smaller, or kind of remaining the same, given the kind of huge impact that AI is going to have? And that when I'm talking specifically in terms of supervision of financial institutions.
Well, in terms of supervision, I thought the important thing is really for the supervisor, just like Jiun said, is to set the guardrails so that the banks or the financial institutions will work within the guardrails. Jiun already talked about the issues that we should pay attention to. In fact, the HKMA adopts a very, very similar approach to the MAS, and we pull out an AI guidance about the same time. And we are also trying to update that guidance to include Gen AI. But I'd just like to say that when AI is more widely adopted, especially with Gen AI, one generic risk that we are seeing may become worse. I talk about concentration risk. And it's not really just about IT failures or cyber attacks or over-reliance on a few firms. But it's also about if all the financial firms are using similar AI firms and models, and if they're trained alike, these financial firms will think alike. And will there be a situation where the financial institutions relying on similar AI models will make investments or business decisions that can exhibit some kind of herding behavior, which is something that we've been discussing, or pro-cyclical behavior? And especially, again, in market stress, will that lead to outcomes like bank runs, fire sales of everybody, liquidity hoarding by everybody, because everybody is using similar models? So I think that's something that we might need to think about as AI is becoming more widely adopted. And I thought it's a supervisor's job to make sure that these issues are thoroughly considered.
Yeah, thank you. I wanted to come to that. So this idea of the kind of concentration of risk, and obviously if everyone's evaluating the same data, as you say, they're likely to be coming to the same conclusions. And that I can see presenting a systemic risk. So what would be the best way to mitigate that kind of risk, if there is any?
Well, one is, of course, if we're talking about IT failures and cybersecurity, for the individual financial institution to make sure that they have sufficient oversight on the third-party service provider, and that they have their own cyber defense, not only on their system, but on their linkage with the service provider. But in terms of the group think, I think the important thing is, again, human in the loop. You really have to put the humans into the judgment decision portion so that the AI model, whatever is churned out, is just giving you a reference, giving you an input. It's the humans that will be making decisions, and humans do not think alike. And I thought that's actually will be a very helpful way to avoid the herding behavior.
Humans don't think alike, but if all of the if the AI becomes so successful at projecting things, or suggesting rates, or whatever it is that the AI proves itself to be most good at, it's going to take a kind of strange or bold human to say, no, I don't. Do you see what I'm saying? If an AI has proved itself to be kind of absolutely spot on every time when it comes to projecting economic growth for the next quarter or whatever, and maybe that kind of groupthink doesn't matter too much, but I wonder whether it's possible to have that kind of human agency when the AI has become, we're talking about years in the future, but when it's become so intelligent that it's quite difficult to kind of disagree with.
Well, for now, what we're seeing is that they're good at predictions, calculations, filling in the blanks. The cognitive ability, the intellectual ability, they're not reaching there. But of course, there could be a day that they could reach there. But still, I still think that it's not. Well, it's very hard. It's of course very hypothetical in that whether AI intelligence can reach human. But I still think that human in the loop is ultimately the answer to avoiding some of the issues that I mentioned.
Okay, thank you. Do you see any specific services that are kind of promising candidates that could be improved in the financial industry by AI? What are the most obvious candidates for improvement by AI, would you think?
Well, maybe I'll start first, and again, I'll pass to Jiun. Some of the things have already been done by the financial institutions, like as we mentioned, fraud detection, AML, or some are putting them to use for client-facing functions like chatbots. digital assistant, stuff like that. Well, I think these are all quite safe applications, but of course, there's got to be safeguards here and there. And one area that I think more banks are using is coding, especially useful if you are restructuring the legacy code so that you can use AI to have more clarity, better performance. They can actually refactor the code without the risk of really crashing the system. So coding is another area that I think more people are using. But when it comes to trading decisions, credit decisions, like Jiun said earlier, I think banks are generally quite cautious in delegating these judgmental tasks to the AIs for now.
Jiun, did you have anything to add on that in terms of what you see as the potential most promising kind of candidates for AI?
So I think one of the promises that sometimes talked about for AI is that it's not yet at the level where it is able to replace the highest level of expert judgment and highly skilled expert trained skills. But it is able to level up middle skilled activities. So certainly, I think in the area of co-piloting, there is potential for productivity gains. So for activities that may be performed by newer officers, not the most highly skilled, require some training, and so therefore there may be, and then there's turnover, of course, in the industry, and therefore the delivery of services tends to be a little bit uneven. AI has the potential to even that up a little bit and level that up a little bit. So I think that's what sometimes we hear people talking about, how it could be very helpful in productivity and leveling up of some of the middle skilled work. I think we do hear about coding being a very promising area where there is a global shortage of software developers. And so actually this comes quite nicely in to fill up that shortage. So it's not the case that there's a replacement of jobs, but it comes in to plug a gap. And so that's quite useful too. I think in the potentially there is quite a lot of use case in climate, and I'm happy to talk about that later. But I've just recently heard about use of AI in climate modeling, and so that becomes quite interesting because they're trying to simulate the entire how would you put it system of the Earth. So atmospheric waves, land movements, everything, and how climate is going to affect this. So it gives you, again, a better read of what our actions today might mean for the climate and for consequences on all of us in the years to come. So
okay, great. I mean, maybe we could move on to climate actually, because I think that's a really important one, and obviously the financial sector plays a big role in the kind of movement. Are you still there, Jiun? Sorry, you've disappeared.
Yes.
Oh, you're still there. Your picture. So how can, and so as you say, AI is potentially very useful for there you are, for kind of looking at climate risks. But what about specifically financial, climate related financial risks, or are you kind of lumping those together? Could you talk a little bit more about that, about how AI could work with kind of sustainable finance?
Yeah. So I think we see great scope again for AI to support sustainable finance and also for generally transitioning the economy, because much of the gap in terms of access to sustainable financing is about closing data gaps, about reporting data, using data to drive change, right? So the stakeholders can make use of the data to drive change. And so if it concerns data, that's an area where AI can come in to try to plug some gaps and improve the situation. right? Both in capturing, and processing data, but also in reporting and making sense of it. So in terms of, maybe I'll speak first about closing data gaps, right? And again, this is about getting sustainability-related analysis done, data that empowers that, and helping corporates with access to sustainable financing with these data gaps plugged, right? So, for instance, I think it's still at an initial stage right now, but there's quite a lot of activity in this space. So I'll give some examples. So at the Singapore FinTech Festival, we have this in November every year. So at the hackathon just last November, we saw a solution that uses AI to help companies score and forecast their carbon emissions based on the purchases they make. So this is looking at their purchases and their bills across various categories and translating that into emissions. And one easy category, of course, is travel, business travel, and or shipping of products. So they can take that, they can estimate the emissions from shipping, from air travel, and then that inputs they can propose. The platform can also propose a path towards reducing this. They can propose alternative means of transport. And so on, right? So I think the more data that's ingested, they can help companies find a better path towards a reduction. So it may be that instead of this material, you could consider this other material. Instead of shipping it from country A, you may consider shipping it from country B, which could be closer. So the potential is there, but the need is to be able to pump in quite a lot of data.
There's a lot of sorry, I was just going to say there's a lot of skepticism, obviously, around sustainable finance and ESG, etc. And I know that the MAS also came up with this idea that AI could be used to identify greenwashing. I wondered if you could tell us a bit about that.
Yeah, so you could train the AI model to do that. So I think with any sets of standards, you could so there are various kinds, right? So from various organizations, there are all kinds of standards. Greenwashing has one of them. We know of some organizations that come up with a checklist or a guide against greenwashing. So you potentially could put that onto a platform. And then you can take the disclosures and statements from a company. You can cross-check it against the standard and match it. And you can, identify issues and non-alignments arising from that. So there are actually platforms out there that do that. So it is being tried. It will have to improve over time. So I think it is a case where here, of course, is as good as the standard or the benchmark that is being built. So over time, that should be improved. That's on the one hand. And on the other hand, of course, is that as corporates are assessed against this benchmark, there needs to be some reinforcement that certain things were picked up well, certain things may have been missed and should have been picked up. And with that reinforcement, the model should be improved. So I think it will improve over time.
Okay, great.
Well, in fact, Jemima, I may supplement here. In fact, we have a green fintech competition as well, and the winner is actually doing something like what Jiun said. The firm, the fintech firm, is looking at listed companies and assess whether they can really achieve the net zero target that they claim by both using the disclosed data of the listed companies and also using unstructured data from the social media news, and also look at the governance and culture through the speeches of different people. So it seems that there are use cases there. And I should also mention the other project that's being done by the BIS Innovation Hub. It's called Symbiosis. It's about disclosure. If you think about Scope 3 disclosure in future, it will be very difficult for SMEs to do it. And whether AI can actually fill some of the data gap and help them with the calculations is what Symbiosis is trying to do.
Okay, brilliant. Thank you very much. Clearly, AI is not something that it's a kind of cross-border phenomenon, right? And it's taking data from the entire globe if it wants to. So given that, I just wondered if we could come to talking about international cooperation, and what do you see as the role of something like the Basel Committee and other such global forums when it comes to both kind of harnessing the potential uses of AI and also mitigating against the risk? And will this be something that requires more, kind of unprecedented cooperation between central banks and at a kind of global level? Either of you, sorry, Jiun, do you want to take that first?
Yeah, I'm sure. No, I think it's really important. I think for the regulatory community to be able to exchange notes on this. I think there's a long history of collaboration for international standard setters and for the community of regulators. It's now about AI, but we've been doing this for many things, right? So I think for climate-related issues, we've been doing this. For crypto, we've been doing this. AI is the latest, but I think it usually starts with just coming together and having an exchange of views. What are you seeing? What are we seeing? Do you have concerns? Talking to industry. So dialogue and exchanges usually is the first step that we find always very, very useful. The second stage, of course, then is to decide if enough of us in the community feel that there is a major concern developing in this area. Therefore, then deciding that maybe a further step has to be taken. Some principles and guidelines may need to be prepared and drafted, and this will help steer and give assistance to all supervisors about how they might be able to look at the issue and address the issue with their financial institutions in their jurisdictions. Of course, at the last stage is if it becomes clearly a critical need, then and there is agreement and it is an area that is suitable, say objective enough, then standards could be developed in that area. So at this point, I think we've benefited already from discussions in the supervisory community about AI, about the various concerns about the use of AI in the industry, and how supervisors should respond to it. I think the conversations have started. And it could develop from there. But I think we're probably at maybe the first or second stage at this point.
Okay, thank you. Right. We're running very close to the end of this. Eddie, what were you going to say?
Well, just on top of what Jiun said, one area that I thought we can again start some dialogue is again about the concentration risk. The third-party service provider is likely to be dominated globally by a few, and whether there should be some common broad parameters that supervisors around the world should ask their banks to do in a kind of consistent way to make sure that their common reliance on these AI firms, at least these firms are properly run with the right governance, with the right cybersecurity defenses, etc. So I thought the third-party service provider area is something that we might want to start more dialogue.
And I'll just maybe add just a quick one, which I think there will be a real good use case for risk taxonomy to be drawn up. I think this will be very helpful to all of us in the community to at least have the same reference to a comprehensive set of risks, and then from there we can develop our own engagements with the financial institutions in our jurisdictions about how financial institutions are addressing these risks as they deploy and use AI models.
Okay, thank you. Quick fire round, final minute. Is AI more of a risk or an opportunity? Eddie?
It's an opportunity, but we need to put proper guardrails.
So more of an opportunity?
Correct.
Jiun, what do you feel?
No, it has to be a well risk managed opportunity.
Oh, come on, you're both hedging. You need to disagree. Well, I thought you were finally going to disagree.
We're supervisors. We look at risk primarily. But we don't think that this is dangerous. I mean, that was your first
That's
question.
interesting.
I mean, we're not in a doomsday scenario, but
Okay.
we recognize that the financial industry will do this. We see benefits to it, but the risks have to be addressed.
Okay, I'm going to wrap up. Thank you so much by saying that the people who are looking most at risk don't see this as a catastrophic risk, so we can all sleep well tonight. Thank you so much, all. Our time is out, so that's all I'm going to really have time to kind of wrap it up with. Thank you so much. That was a really, really interesting discussion, even though the governor of the Bank of Spain couldn't make it in the end. Thank you both really very much. That was great. And thanks all of you in Switzerland. Sorry, I couldn't be there.
Thank you very much.
Thank you.